Thank you, Alexandra, for having me.
So I'd like to kick off with what are your thoughts on the auctions that we saw this week, and what are they suggesting?
Well, I believe that the auction indicated that the market is clearly divided. On one side, the bond market believes that long-term yields need to go higher, and the reason behind that is that the Federal Reserve is going to engage also in balance sheet runoff in order to tighten the economy, which puts upwards pressure on long-term yields. But there is another sizable part of the market that believes that a more aggressive Federal Reserve at the end means that we will have a slowdown in growth. Therefore, that concept keeps in check the long part of the yield curve. What we actually have seen, Alexandra, is that during the 10 years US Treasury auction and the 30-year Treasury auction that we had on Wednesday and Thursday, indirect bidders were mixed. They were dropping in the 10 years US Treasury auction, and they were rising in the 30-year US Treasury auctions. So basically means that the investors are taking a longer duration on the back of what we just said, that they're scared of a slowdown in growth. But at the same time, both auctions had a very small tail. With tail, I mean that the auctions priced at a higher yield than when issued, and that's an indication that the investors still look for higher yields on the long part of the yield curve.
On the other side, I was wondering, this recent surge in treasury yields, what is the bond market suggesting in terms of Fed's future monetary policy? Because we saw yesterday also Lael Brainerd, the vice president of the Fed, who, by the way, confirmed the Fed policy, which means trying to calm down inflationary pressures to the upside.
Absolutely. I think that at this point, well, from the move of the market since the beginning of the year until now, it's clear that the market is confused on what is going to happen, and is trying to reprise and take positions for the year coming. We believe that the only direction for the US Treasury yield curve is to bear flatten, so the front part of the yield curve rising faster than the longer part of the yield curve. And the reason for that is that it's clear at this point that the Federal Reserve needs to hike rates aggressively, and needs to combine an hiking interest rate cycle with also the runoff of the balance sheet. So definitely that means that there is going to be upward pressure, especially on the front part of the yield curve, but there will be some pressure also on the long part of the yield curve. But long-term yields will not be able to rise as fast as we've seen since the beginning of the year. Indeed, we believe that 10 years yields will find a very strong resistance at 2%, and they would struggle to rise above this level by the end of the year. And the reason behind that is that just now, Alexandra, we received retail sales data from the US. They were much weaker than the market expected for the month of December. That means that the GDP growth for 2022 needs to be revised downwards. So definitely there is going to be a slowdown in growth, which will keep compressed the long part of the yield curve.
So I was wondering, you just mentioned the retail sales minus 1.9%. That was a surprise, that's for sure. On the other side, yesterday we saw the PPI, which was slightly below expectations. Do you think that inflation actually has peaked in the US?
No, well, we believe that, yes, it might be the peak. However, we are not certain about that, because there is some data that shows us that there are still growing pressure, especially because of the energy crunch that we are witnessing to. And also we have to bear in mind that the service sector is still in a partial lockdown. There is still Omicron circulating, which means that a lot of these activities are closed, and it seems that inflation continues to grow in the in the service sector. So it might have peaked, but there might be a surprise. But the question might not be whether if we have reached the peak or not. The question is in the long term where inflation is going to stabilize. And we are definitely sure that this year we'll see inflation moderating, but in the long term, it will not drop to the Fed target of 2%. We believe that it will stay much higher, between 3 to 5%, depending how serious this energy crunch is going to be.
So let me ask you one final take on European bond yields, specifically 10-year Italian is extremely interesting. I don't know if you've seen the levels right there. The 10-year at 1.3% so far. And also the spread between the 10-year Italian and the 10-year German Bund is slightly higher at 138 basis points. Do you think that this is suggesting a more interesting European bond market in terms of yields?
Absolutely. We believe that this year, 2022, all stars align for bond yields to become positive. And we don't believe that is going to take long. We believe that is going to be a matter of weeks before we see 10 years bond yields breaking above 0%. That means that every other sovereign in the euro area will need to reprice higher. And the BTPs, Italian government bonds, which carry a much higher beta than other countries, obviously will suffer the most. And Alexandra, we have also to think that Italy has also other issues that are more linked to the political scenario. So we are seeing in the best case scenario, the BTP Bund spread widening to 160 basis points before resuming its tightening against the German Bund. But if we have a political crisis, because, for example, Draghi leaves his seat as prime minister to take on the presidential seat, in that case, the spread could spike even above 200 basis points.
Thank you very much, Althea Spinozzi, fixed income strategist, Saxo Bank. Thank you for joining us, and of course, have a great weekend.
Thank you, Alexandra. You too.